We're in this session in Chapter 7 where we're talking about working capital management. Now, working capital, just as a reminder for what we talked about in previous chapters, working capital consists of current assets and current liabilities. What's sometimes referred to as gross working capital are the current asset side, which is your cash, marketable securities, accounts receivable, and inventory. And the net working capital is the difference between current assets minus current liabilities. Now, just as a reminder, current assets are all of those assets that are expected to be converted to cash or cash equivalents within the next 12 months. And current liabilities are all of those monies that are owed or are going to be convertible to be paid off within the next 12 months. So working capital management is actually effectively and efficiently controlling your current assets and your current liabilities in a manner that provides the firm with the maximum return on its assets, will minimize payments for its liabilities, and in essence will control and manage the liquidity of a company itself. Now, because revenues can be spotty, can be sporadic sometimes, and it's very difficult to usually for a small business or any business to manage its revenues, and expenses just seem to come with amazing regularity. This is sometimes the more difficult part of anybody to manage, but one of the most important components to manage on an ongoing basis. So let's talk about first the current asset side of things and managing current assets. And there's really four component pieces I want to talk about today. The first one is cash management itself. Then there's also marketable securities and accounts receivable and inventory management. So let's begin by first of all just talking about cash management, because the goal of cash management is to obtain the highest return possible on your cash while also maintaining complete liquidity. So cash, of course, consists of petty cash, cash on hand, cash that's in the bank in your checking account, and cash also that's in the savings account itself. Now, each of these line items, depending upon what kind of business you are, especially the petty cash and the cash on hand, if you happen to be in retailer, these can be significant kind of items, so there's certain security items that you're going to want to take into account on that. But let's just talk conceptually about the concept of float itself. Float there's two kinds of float. There's the disbursement float and the collections float. The disbursement float is the time on your side that happens between when you pay by check and the check actually clearing the bank, at which point in time the funds are removed from your checking account. And so this is referred to as float. Disbursement float. There's also the collections float, which happens the other way, is when that elapses between the time that you are depositing a check from that somebody's paying you and the clearing time when it actually gets placed into your account itself. And one of the things that you want to be very cognizant of as a business owner is just managing the float on the collections. Quite often, companies will play games where they may actually, I say play games, but it's actually good management principles, where they will, in essence, pay out of a lockbox or collect out of a lockbox. For example, if a company is actually selling across the nation, and they're physically located in, let's say, in California, and they're selling across the nation, they quite often will have collections for companies that are on the East Coast. And there's a time between the time that the company on the East Coast will actually cut a check to pay to you, when it comes in the mail itself, and then you're received by yourself, and then you put it into the account. And if it's an East Coast account, then there may be a little bit of delay there. So quite often, companies will set up lockboxes. So if you happen to be on the East Coast, you'll actually be remitting a check to a lockbox that is on the East Coast to reduce this flow time. Also, electronic funds transfers are an in essence, used to reduce this float time itself. So just understanding that there's tools out there like this so that you can reduce your float time, reduce that time, because the larger the amount, losing 2 or 3 days worth of cash in the usage and access to that cash can be very significant. There's also marketable securities management itself. And marketable securities are normally those investment vehicles that include U.S. Treasury bills and government bonds and stocks. And any excess cash that you are sitting around that you are not going to need in the short term, you should consider putting into a safe marketable security kind of vehicle itself, where at least you can get some interest or you can see some increase in value on that, especially if it's something like a T-bill or something else. Now let's talk about accounts receivable management itself. The goal of accounts receivable management is to increase your sales by offering credit to customers. And options to offering credit may include your own credit line or line of credit. There's also something out there called factoring of accounts receivable, where you in essence are selling your receivables to another firm at a discount price of the original sales price. Factoring itself can be, especially if a company is in some financial crunch, can be an effective way of getting some cash up front. But factoring in and of itself can be an expensive way of getting that cash. So again, you may or may not want to consider doing factoring. With respect to extending credit and the choice of extending credit to customers and in essence incurring accounts receivable balance, something called the 5 C's of credit. You're going to be looking at a customer's character to see if that is favorable. If a customer has paid their bills on time in the past and they have favorable credit references, that is, you feel pretty good about extending them credit. There's what's called the capacity to pay, refers to whether or not the customer has enough cash flow or disposable income to pay back a loan or pay off a bill. There's the C, which is the underlying capital or net worth of a company, which is their total assets minus their total liabilities. There's the possibility of collateral, ability to satisfy a debt or pay a creditor by selling assets for cash. And there's also the conditions which surround you extending credit to somebody else, which is the general state of the economy or the borrower's specific conditions. For example, borrowers who have a high value in real estate with a rapidly declining real estate market in the general environment, they may be considered too risky for you to extend any sort of credit to itself. There's when you extend credit as part of accounts receivable management, there are usually credit terms that you then extend to them. For example, credit terms are the requirements for a business to repay that sale or that amount of credit. To speed up collections, quite often cash discounts are often offered to a business customer. For example, there may be terms of what's called 210 net 30. And this says that if a customer pays the bill within 10 days of the invoice, a 2% discount is given. Otherwise, the entire net is due 20 days later or at the 30th day. You'll also see this on the payable side. You'll see it on the reverse side where you may be given the option of paying 210 net 30. And usually from the payable side, we'll get to that when we talk about accounts payable management, that kind of option is an option that on the payable side you always want to take. Taking it on the receivable side it becomes a little more expensive for you to offer that, but when you begin to factor in about the lost revenue stream, the potential bad debt, and other aspects of this, you're almost always willing to get that cash up front and to get some benefit for it. In previous chapters, we looked at this ratio, this analysis of accounts receivable turnover. And again, just as a reminder, accounts receivable turnover is your credit sales divided by your average accounts receivable balance, which is your beginning and your ending accounts receivable for whatever that credit sales period is. And then you can divide that into 365 to get what your accounts receivable, your average collection days are. And the reason average collection days is important is you use this example in this calculation of it's 61 days of average collection days. Well, if your terms are 30 days, everything's due in 30 days, obviously you have an issue out there with respect to collecting your receivables. So if your collection days exceed your credit terms, which in our examples it does, then we have to speed up our collections. We have to do things to do a better job of getting those collections. If we give terms of 30 days and we wind up collecting in 61 days, we have to better manage those accounts receivable, which means we need to reevaluate our credit policies, and maybe that we are extending credit to people that we can no longer extend credit terms to because they're just not paying as often. If our collection days are less than our terms, then we have increased our liquidity. So if our collection days are 20 days and our terms are 30 days, we're doing better. If our collection days in the past have been 61 days and we've been able to do some things, increased collection calls, a little more sending Guido out for a visit, whatever it may be, and we're able to reduce the collection days from 61 days to 50 days, we're actually increasing our liquidity itself. That's a good thing. So how do you kind of keep on top of your portfolio of accounts receivable? Of course, you want to keep your overall ratios and these kind of analysis in place. You also want to periodically review what's called an aging of accounts receivable. And this is just basically looking at the individual items within your accounts receivable and what are the outstanding days that are out there. And so on this aging schedule that you see on the screen, for example, you can see that different customers have different number of items that are out there and how long they've been out there. And again, for any one customer, it may be more than just the total for the customer itself. You actually may have an aging by invoices that are out there. And obviously, when you start to get into customers like customer number 7 and customer number 8 here, where you have average balances way out there, you really don't want to be considering giving them additional sales until you've taken care of those old balances and also what are the underlying conditions that have caused them to have those kind of agings. Sometimes there's a dispute over an item, over a handling of an item, that until you get that dispute resolved, those items are going to be staying out there. Sometimes customers are doing their own cash flow management, and they are intentionally kind of dragging you out because they're having their own liquidity problems. So you just need to understand and be on top of what exactly is going on there. The overall goal of well, let's talk inventory management now. The overall goal of inventory management is to minimize your total inventory cost while maximizing customer satisfaction. So there's two underlying decisions that always have to be made if you are carrying inventory. One of them is to establish when do you reorder inventory and what is that reorder point, the level of inventory that it falls down to when a new order is going to be placed. Whenever you're looking at inventory management, especially if you're either in manufacturing or you're in retail sales, is you don't want to lose sales by running out of inventory. Conversely, you don't want to have so much inventory that the cost of carrying that inventory becomes prohibitive. And so there's always certain decisions that you have to make with respect to inventory itself. And one of the items that I want to talk about is just what's called reorder or economic order quantity formula. And first of all, just look at this and you can see an example of what I am talking about. As the weeks go on, let's say you start off with 110 units and you sell those units and you get down to a point where there's I don't ever want to have less than 10 units on hand. That's what is referred to as safety stock, and it could be, if you're a retailer, you want to have at least 10 units out on the shelf or in the back room. If you're a manufacturer, you may say, I need those 10 units to be able to manufacture what I'm manufacturing. And so you say, I never want to get below 10 units. And so you're going to look at and say, if my lead time to order units it takes 2 weeks for units to come in when I reorder, that's where you can kind of understand conceptually here is what is happening is you are either using your inventory in manufacturing or you're selling your inventory, and you know that at this rate it's going to take 2 weeks for you to get that reorder. That then allows you to calculate what your maximum inventory quantity is and when you need to reorder that inventory. So this just can be basically figured out using a formula. And what this formula does is it tries to balance the ordering of your inventory, your ordering costs and your storage costs, and what the quantity is. And again, don't get too hung up in here, other than just understanding that there is an economic order quantity that is the square root of twice your annual demand, or whatever the period is that you're calculating for, times the ordering cost per item, divided by what the carrying cost for that item is, usually as a percentage, and the unit cost of that item. And you sit there and it's just a number that you can plug in to actually get the quantity that is your ideal quantity. Also, if there are quantity discounts, just to understand, and the textbook goes into this in more detail, understand that you may have to take into account quantity discounts to overwrite some of your EOQ formula itself. So as we're talking about, again, this reorder, there's this reorder point calculation that we talked about, and the reorder point calculation is basically taking into account 3 factors: that the lead time of placing the order, what your demand is, and what the safety stock is that you're going to be looking for. And all of those things become an important part of just managing your inventory itself. So if you are a person who is in charge of either in a manufacturing facility, or you are a business that has retail inventory, these are important items that factor into you managing your current assets, your inventory itself. There's also something out there I'm just going to mention here called just-in-time inventory. More and more you are starting to see this, especially with respect to able to manage inventory on a computer, where you minimize your lead times, you minimize your safety stock, and you basically say, I'm going to have inventory that's going to arrive in the door just in time for me to put it back out into use. And it's primarily used in manufacturing, because retailers don't necessarily want to be managing quite closely to something, to the just-in-time inventory, because sometimes just-in-time you can get caught short. But you have to have certain things like an inventory. A vendor has to be very reliable on their inventory. And sometimes vendors will even deliver on an hourly or daily basis to help to manage this. And this, of course, is for larger businesses where there's a higher degree of volume. Right now, for small retailers, especially if you're able to use something like Prime on Amazon.com, where you're pretty much guaranteed that you can get delivery within 2 or 3 days maximum. This really does allow you to shorten the amount of time that you are carrying inventory. Now, just to let you know, there are different kinds of inventories out there. And this, again, don't want to get too much in the details, because if you go into management accounting type courses, you can get into this even more. But the type of inventories that are out there's what's called raw materials, which is that which a company uses in producing its final product. There's work in process inventories that are made up of items that are being produced. There's finished good inventories, and then there are inventories that are just maintenance, repair, and operating inventories used by those things that a company may use in normal operations but are not manufactured or sold by the firm. So let me just give you an example here. Just think of a manufacturer like a car. A car manufacturer. They're going to purchase raw materials out there. They may purchase, tires or fenders or those kinds of things that become part of their process of coming up with the final car. And work in process would be those things that they've started a manufacturing line, a assembly line process, and a car is only partially built. And finished goods, of course, is at the far end, is when a car is finally completed and it's sitting on a lot ready to be shipped out to a dealer. And again, that's kind of a big picture thing. A maintenance, repair, and operating. They may buy large quantities of motor oil, for example, that will actually either go into the car or may be used itself to keep the assembly line equipment running. So that's a real big type of example, but there are smaller examples. If you build and manufacture furniture, for example, you're going to have different components of that. Just to make reference to what is kind of considered is called Pareto's Law, or the 80-20 rule, is just understand that just generally a large percentage of the total cost of your inventory is found in a relatively small percent of your inventory. So, for example, it's what's called ABC. A items is 5 to 10% of your inventory, whether it's stock keeping units or what's called SKUs themselves, are probably about 75% of the total cost of your inventory. Your B items is usually another 10 to 15%, are covered by 10 to 15% of the cost. And then the C items is the remaining 75 to 80% of your SKU items, are really only 10 to 15% of your costs. So, just understand that kind of tends to be a generalization that holds true, whether you're in retail and what the makeup is of your SKUs that are out on the shelves, or of your inventory that is going into manufacturing itself. So again, there are formulas that allow you to be able to compute the cost of what each inventory item is and the cost of what is consumed. So we won't get into too much more detail than that. Let's jump over to the current liability side and what we're talking about when we talk about managing current liabilities. And there's really three categories I want to make reference to. There's short-term debt management, what's called accrued liabilities management, and accounts payable management. So let's start first with short-term debt management. Short-term debt consists of all those obligations that are going to be paid within the current accounting period, usually referring to the next 12 months. They consist of current payments on long-term debt, all of those payments that are going to be due in the next 12 months on a longer-term debt, bank lines of credit, notes payable, accounts payable, short-term loans, any other short-term loans that are due within 1 year. Obviously, a line of credit that is out there is similar to a credit card. With the line of credits that we get usually from the bank, we're not obligated to make payments unless we actually borrow the money. So a line of credit is normally obtained from our primary bank itself, and it's used just to kind of cover when we have a deficiency and our cash outflow exceeds our cash inflow itself, and it kind of helps to smooth out and make sure that we're able to take advantage of keeping good customer relations even when our cash inflow might be slowing down for a little bit. And so having a line of credit is a great way of us managing and taking care of the liability side, while we sometimes will see some fluctuations on the asset side itself. Accrued liabilities are those obligations that we are obligated that are accumulated during the normal course of business, and usually they're payroll taxes and payroll insurance and property taxes and sales taxes, those kinds of things. That again, we want to manage those things well by paying them when they're due, ensuring we have adequate liquidity to pay those items when they're due, so that we don't get into trouble in those areas in our business itself. And that's why lines of credit can become very useful, because you definitely don't ever want to be late on payroll taxes. You definitely don't want to be late on paying any payroll itself. And property taxes and sales taxes, I mean, those are, again, are big no-nos for ever missing due dates on that. So let's talk a little bit about accounts payable, because accounts payable are the debts of a business which are owed to our vendors. And our vendors will usually allow us and provide for us certain kinds of discounts. There's trade discounts, there's cash discounts, there's quantity discounts. So let's talk about the discounts and what those are specifically. Trade discounts are amounts that are deducted from the list price of items when specific services are performed by the trade customer. And for example, a lot of times you'll see trade discounts expressed either as a single amount or in a series, such as 30, 20, 10. And what these are is these really allow you to take whatever your list price is and to deduct from the list prices from the vendor to be able to pay for those things. And the calculation of trade discounts can very simply be expressed and calculated out. For example, in the example we just said, the 30, 20, 10 is if we have a relationship with the vendor, they'll tell us, here's your list price of $300, but you are able to pay for 30, 20, 10. And sometimes it may be if you're buying and paying within certain time frames, if you're a certain valued customer, if you fall under this kind of buying these kind of items, you will be given those kinds of terms. And what a 30, 20, 10 basically says is, for that list price of $300, you only have to pay $151.20, which means you're paying close to 50% of list price itself. So the terms themselves, the net cost rate factor is the actual percentage of the list price paid after taking whatever trade discounts you're allowed. So in this example, it's 50.4%. So the single equivalent discount factor is just the contra to that, is the 49.6% in essence. So that's just understand those are kind of ways that sometimes that vendors will try to help you to feel better about what you're actually paying. And obviously, the more you buy, the better customer you are, the more you're able to take advantage of those trade discounts. There are also discounts out there that are given to just vendors and customers in general, which are called cash discounts, to give you the incentive to pay promptly. And the seller himself views a cash discount as a sales discount. So they are looking at it as a sales discount to you. You're looking at it as a purchase discount. So this cash discount can play an important role in determining how much of the invoice you're going to pay. Let's just look at an example. If a cash discount, if somebody sells you and you owe them money and the terms are 210 net 30, what this means is if you pay within 10 days, you can take 2% off. In other words, you're paying 98% of the invoice itself. And if you don't pay within 10 days, then the net amount is due at 30 days itself. And if you don't pay if you don't pay within 30 days, then quite often the agreements will say there'll be a monthly interest charge that will be added to the unpaid balance. For example, it might be 2% for every 30 days after that. And so what this means is, just to give you an example, is if you have a $10,000 invoice with terms of 210 net 30, you've got options there. You can pay off the $10,000, but with within 10 days and only pay $9,800. And of course, you can see how the calculation for that is. And there's almost always an advantage when you get those kind of terms. The second option, of course, that you run is you don't pay the $10,000. You don't pay $9,800 within 10 days. You wait until the 30th day. Now, let me give you just a word of advice. If you decide not to take advantage of cash discounts, a 2% for 2%, 10, a 210, net 30, is you are basically paying 36% interest by delaying your payment. So when you have the opportunity to do so, especially when it's something like 2%, is always take advantage of paying within those 10 days. Because the effective interest rate of 36%, you can't do any better on that. So you're almost always better off taking advantage of the cash discount. Don't take the cash discount and pay within 30 days, because what that does is that really starts to create problems in your vendor relationships, because you're putting your vendor in between a rock and a hard place. They're going to come back and say, wait a minute, you're not due the 2%, and they're going to try to get their money back, or they're going to have a bad taste in their mouth about having a working relationship with you. And one of the things you want to do as a company is you want to cultivate good working relationships, not only with your customers, but also with your vendors. Because initially you may not get the 2% 10, but initially they may only give you a net 30. But if you pay timely, no matter what your terms are, you always then are opening up the door for later on being able to come back and say to a vendor, I'd like to have a little better terms if I pay a little more promptly. Will you give me more discount? And if you have a good history, they're almost always going to be open to talking to you about that if they are giving others of their customers similar kinds of terms. Until next time. Oh, I want to just reference, that's right, I want to reference one more item, which has to do with quantity discounts. Quantity discounts are offered by vendors to entice you to purchase larger items in larger quantities. And again, this goes back as to whether or not it really makes sense as to how quickly you're able to use up that which you are buying. So again, this is going to be on a case by case, where you're going to determine whether those quantity discounts are really worth you taking advantage of. And that, again, when you look at the inventory side of things, if you are purchasing inventory, you factor those kinds of things in your economic order quantities themselves. Until our next session.